Welcome to Checks Over Strikes podcast.
Checks in your name, no strikes against it. This is episode 2, and we got something fun for you guys. We're going to talk about first-time home purchasing or the misconceptions of buying a first home. These are questions that people have a lot of, and sometimes the misconceptions is that you don't need a certain amount of down payment, or people don't understand the stress test. You know, what are types of mortgage rates that you guys have out there? So these are all the things that, you know, I think we need to equip people as they become first-time home buyers. And yeah, we're going to get started. We want to introduce my team here, my trusted partner and friend.
What's going on, people? It's Dean Chambers.
And our producer / the big guy, Jason Allen John, is in the building.
Yes. Producer.
Hey, man, that's what you are, man.
Hey.
Take it or leave it.
Hey. If the shoe fits, you wear it, right?
Exactly. And it fits, man, so just wear it.
All right. What's up, people? How you guys doing today? What's up? This is episode 2, eh?
Yeah, 2.
Yep.
You're on a roll here. 2 episodes.
2 episodes. Let's get it done, man. How was you guys all week, man?
My week it's the same. Still COVID. I got the kids, so trying to balance family life and work life at the same time can be challenging. But, you know, sometimes you just got to roll with the punches. Life is all about unexpected events. So you just got to take what comes to you and just adapt to it, you know?
Well, for me, all I can say is I can't wait for February 16th because that date is when the kids go back to school, and this online learning thing, it just ain't working. I need to free up my time. So can't wait for February 16th. To all the people that have kids out there that's driving them nuts at home and taking up their Wi-Fi, hey, let's boot them back to school, man. That's what I'm waiting on.
I hear that.
Is it really that much? They take that much Wi-Fi?
Yeah, man. Well, I got 2 kids.
Uh-huh.
They're streaming.
Okay.
So, and then when I have calls myself, I'm doing Zoom, I'm streaming.
Yeah.
Then I have a significant other at home. She's streaming at times when she's doing her meetings. So all that Wi-Fi is getting, used up.
Yeah.
They said they had to move a whole bunch of bandwidth from the commercial space to the residential space when everyone started working from home. So it's crazy how these things change, different trends and all that kind of stuff, right? So
yeah,
it's kind of
Makes
cool.
sense.
Yeah, my week was all right. It was kind of cool, regular. It was cold, but, it's February. I like the cold. And, doing the 75 hard challenge, I'm still trekking it outside.
Oh, where you at with that?
So
What day we at?
We're at day, I guess this is going to date this podcast, but we're at day 30, day 35. So
All right.
we're creeping up to that halfway point. You know what I mean?
Yeah.
Proud of my peoples that have joined me. All the troops, shout out, bat. But yeah, good week always. Positive, lots of things to be thankful for, and yeah, let's get into it. First time buyers, I want to hear it. What you gonna give me some questions? Because normally, guys, I don't talk on this podcast like this, so this is gonna be exclusive.
Well, you know what? I just think that me and Dean come across certain questions people ask us, and it's not funny, but it's just when you don't know what you don't know, people have different misconceptions of what something is. And instead of asking that question, they go out on a limb and just say, you know what, but I'm going to go with that, not really knowing, what they're doing. So hence the reason for, the questions and this topic today, because I think it's really important for individuals to know what they're getting into when they're purchasing a home. Because if they don't, they can fall into, major pitfalls, which can, cost them their down payment, their house.
Yeah.
So it's just something exactly. So it's just something that we think it's needed. And again, it's just helping people providing them with insight of what they need to do. So the first question I have, and again, don't get it twisted. This is not a dumb question because it's important to know. What is a stress test and why is it important?
Well, it's not they say no question is a dumb question, right? What's a stress test? So A stress test is meant to test your abilities to handle rising interest rates on a mortgage. So it was implemented in 2017 or 2016, I think. And the reason why, because the markets were so hot, but the government wasn't able to cool the markets with higher interest rates, because that would affect our exporting and other sectors of the economy. Because best believe it, Canada has other sectors besides real estate.
As they should.
As they should. I'm just laughing because, a lot of people are in real estate, and it's a big proponent of especially our Ontario economy. But the government they couldn't affect it, right? Because a lot of times interest rates, if you think about it, is a national effect. But a lot of the times when you hear about the hot market, especially us in the GTA, it's really GTA specific. So other provinces may not have these same rising prices or whatever. So they came up with a stress test to just manage so let's just say rates were to go up. So when you apply for a mortgage, I actually have to approve you at a rate of 4.79% right now, right? And that is called the qualifying rate. But right now, the 5-year fixed rate is averaging between 1.99 to as low as 1.54. So when you think about that, that's such a big difference. So if you were to get tested at such a big range in what you're paying, it makes you feel like this doesn't make any sense, right? So, there's been some talks that they may change that. I can't see them changing it because the market's so hot. I can't see them doing that. But it's not meant to stress anybody out. But if you can say that you can get approved for almost at 5% interest rate, then you can handle this house. Mm-hmm. So it's a good thing also too for stability for our market, for the economy, for everything. So although it sucks for some people when you're trying to qualify, and then I'm like, you need to get a co-signer or you can't afford that house. So in that moment it sucks. But as far as for the general economy, I don't know where prices would be if there wasn't no stress test. To tell you the truth.
And it's funny because and I'll let Dean take this over just because he had a question about what the stress test is, and I just want to put it over to Dean. What is not a stress test? Just so everyone's clear.
So what is not a stress test is visiting your doctor to see if you can manage the mortgage that you're taking on. So you don't need to go to the doctor to figure out if you'll be stressed out based on the mortgage payment that you'll be paying. So it has nothing to do with going to the doctor, just the amount of money that you'll be paying out towards a mortgage, as Jason was mentioning to you.
So it's just I think a lot of it has to do with planning. Like anyone who knows me, if you've been a client, or planning is important. You got to plan what you buy, where you buy, and how much you spend. So the stress test, yes, it sucks, but it's a part of the game, and it's a rule. So if you want to get a house, you got to apply the stress test. So at the end of the day, there's nothing around it. We just got to get over it and get it done.
So Jay, you mentioned something very key, planning.
Yeah.
How long should an individual plan to make that step? Should they come to you 30 days before wanting to purchase a house? Or, you know what I mean? What should they be doing? What should people be thinking?
I think, to be honest with you, from the moment you say you want to be involved in real estate, you should sit down with somebody. Immediately. You could be 21 and want to buy a house one day, and you can start planning. You could be all 15 and start planning to save your money, right?
Yeah.
So I think the process needs to start the moment that you're interested in buying a property, or you're moving from a property, or you want to refinance a property. A lot of people do it on a reactive basis. I think society is very reactive, if you guys know. You only do stuff when you get burned. So you don't protect yourself in advance, right?
Yeah.
Mm-hmm. So I think it's important because there's opportunities you can take advantage of, especially as a first-time home buyer, if you plan. A lot of the things you can't take advantage for if you don't plan. And it's key to even all the aspects of life too, because I don't know if you guys notice it, but there's a lot of people that own businesses and they weren't incorporated or they weren't set up properly. And then all of a sudden now during COVID and there's government benefits, you don't qualify over like silly things. Like you just don't have a bank account open or you haven't incorporated. And that's all part of planning. So when I look at that, I'm like, oh, you never planned to be successful. You know what I mean? You never thought your business was going to do well, or you never thought you would be able to buy a house. Like you're just waking up one morning and rolling over and like, I'm going to buy a house. Like it's the biggest purchase, right? You're ever going to make. You know, recently I ran on this statistic. Like if you buy a house and it's like $500,000, to pay off that mortgage, you need to earn almost $1.2 million of income. So when you think about that, wouldn't you plan your house or take more time than just running towards me? So, and I need to buy a house, or running towards a realtor or running towards the bank. Yeah. So I think it's take advantage of individuals like myself, any mortgage agents. Most people love to sit down with people and plan it out and, you know, make sure you don't make a mistake, because we don't like rushing. Because what happens is the lenders don't like rushing. And then if you are rushing, you seem as someone that is not like credit worthy, right? So that's all part of when you're doing an application, you know? So get that pre-approval, see how much government benefits you can get, and speak with someone as soon as you can.
Good. Those are some great gems. A second question that I'm going to get into is your down payment. A lot of people know, or some people do know, or some people do not know that they have to have a down payment. Sometimes it could be, you know, some people want to put down 20%, 5%, 10%, depending on, you know, how much money they have. But why is it, or why is your down payment just simply not enough when you're purchasing your first home?
Oh, that's a great question, because down payment is just part of the home buying process, right? So I guess you could split the home buying process in the stuff that you need to acquire the property as debt, and like the accessories that are a part of it. So it's kind of like, you know, when you buy a toy from the store, but it doesn't come with batteries.
Exactly. Perfect analogy. Perfect.
Then, you bring it home and you're all excited to play with it. You open it up and you're like, oh man, damn, I need some AA batteries. Bro. Or it's those ones that you can't even get at the convenience store, like 16 volts. Like that. So I liken it to that, right? So like you can get the toy, but you have to get the batteries. So batteries, I would say, in equivalent to a house, would be like land transfer tax, legal fees. There's HST on the mortgage premium if you put less than 5% down, or less than 20% down. I mean, and everyone gets caught up in that. Like, you know, that could be as much as like $2,000, $3,000. You can have closing costs as much as $15,000 to $20,000 depending on the size of your house, and upwards of, I've seen hundreds of thousands of dollars when you buy like multi-million-dollar properties, right? Because the land transfer tax is a percentage of the property you're buying, typically, you know, between 0.75 and 1.25%. So on average, we like to say you need 1.5% on top of your purchase price set aside from your down payment, you know? So for a house that's like 400,000, you're talking like $6,000.
So you mentioned insurance fees, like insurance fee. Who does that benefit? The house for when you purchase it, or does that benefit the bank?
Well, there's two types of insurance when it comes to a house. They talk about home insurance that protect you in the event of fire, water, damage, theft, that type of insurance.
Okay.
Personal goods and stuff. And then there's mortgage insurance. What mortgage insurance is actually default insurance. So if you default, the bank doesn't lose money, and you pay the cost for that. And that cost could be as high as 4.75% of the value of the home. So when you're putting 5% of the house, you really only have 0.25% equity in the house on day one. So you basically are negative equity from the beginning.
So to our listeners out there, our viewers, there's a difference between house insurance and mortgage insurance. Make sure you guys know the difference because it's important.
Yeah, and then on that mortgage insurance, you have to pay HST. So when you close, or Yeah, or GST. I think it's just GST. It's 6%, or 7%. I mean. So then when you close, let's just say that premium's all like $20,000. You have to pay 7% of that in a tax, just like when you buy a can of pop or something like that, right? So it adds up, you know. So it's not cheap. So a lot of times people scramble on closing day, and I think Dean, you even have a story of that, like scrambling on closing day and like having to search for $5-6 grand. It happens more than enough, right? And that happens sometimes. Again, lack of planning, and then at times like myself, I've been there, not told my customers this. Like you get excited, you want the mortgage closed, you're overwhelmed, and this happens when you're rushed.
Yeah.
You forget little things, and those are the little things you forget. Forget to tell a customer, oh, make sure you have this money set aside or something like that, right? So we got to plan this out and put that out on a piece of paper so you know exactly what you're walking into, right? And then nowadays with these bidding wars, like you don't even know what you're doing. You're just throwing darts at the wall and kind of hoping that someone takes it.
Yeah.
Dean, can you share that real life situation, that experience that you went through with regards to closing?
So, purchase a house, had the down payment, saved up, well ready to buy the house, find the house, and so I put the down payment into the lawyer. Lawyer holds it, and now we're coming to closing costs. So a few days before, I'm getting the paperwork to say, hey, this is where the disbursements and whatnot needs to be paid out. And I seen lawyer fees, CMHC, and I was like, what's all this extra cost? So they're like, oh, this is what you have to pay out because you're not paying 20% on the property. So I was like, nobody told me that. It's like, how was I supposed to know that? So between that and the lawyer fees, literally I had a couple of days to figure out where am I going to get this money from or I lose this property. So I had to dip into my investment account and sell my stocks just to make sure that I had the closing costs so that I got my property, because if I didn't come up with that money, I would have lost my down payment and have nowhere to live. So it was a learning lesson. So that's a story for you guys to know. Your down payment is not enough. They usually say, what is it? If you're 1.5% above or 1.5% of the purchase of the house, you want to make sure you have that for closing costs.
Yeah, guys. I couldn't say it any better than that. It's either you're failing to plan, or you plan to fail. Choose your poison, because it's important.
One or the other.
Yep.
Yeah. So with that being said, we're gonna go right into our next question, and I think this is actually a really good question, because it kind of segues into when you fail to plan and you kind of need some extra money to get your closing. When you think about your down payments and your amounts and the gift letter. So, I've seen this, you need some extra money, or the lender says, I need to see your last 6 months of, your account, and people need that additional cash to show that, hey, I can do this. So they go to a family member or a friend and they get a gift letter. Jason, can you kind of go into a little bit more as to, why that happens and what is a gift letter and what is the amount that you can actually kind of put on that gift letter to ensure that the bank sees that, hey, you have, the monetary funds to do what you need to do?
Yeah. So there's a couple of parts when you're purchasing a home, right? And, we're still on the down payment side of it and why it's not just enough for the down payment. So let's just run into a situation like you were a Dean. You found out last minute that you needed an extra $10,000. Dean was good that he saved and he had stocks, but if you didn't, and you had to go to trustee old mother, father, or brother, sister, technically you're only allowed to take gifts from immediate family members. Because otherwise, the bank assumes it's like a loan. And if it's a loan, we have to service that. And then that could make you not get approved. So you can get a gift letter for as much as down payment as you need for the entire down payment. Okay. That's something you need to let the bank know at time of application. Again, it's all about disclosure. So Banks, you can. There's always exceptions to rules and get everything done, but as long as you tell people, no one likes to be caught off guard,
Yeah.
and I'm sure none of us do, and told stuff last minute, right?
Yeah.
So I tend to feel like people think they could just tell the banks anything and say like you're supposed to accept it, and it's their money. Like, do you ever think about that? Like, people are always just like, oh, it's my, I don't they want my business? And I'm like, yeah, they do, but like it's still their money. So whether they want your business or not, they're not gonna risk money just because they want business. That's terrible business practice, right? So, and you have to remember the banks have shareholders. So most of the times the rules has nothing to do with what they want to do. It's the rules that the shareholders tell them and the rules that the government. There's anti-money laundering rules, and that's why a lot of these things, these gift letters and stuff are in place, because they don't want terrorist financing or illegal illicit money or whatever, right? So it's a lot of it is prudency, right? And that's why we only accept gifts from family members. So again, if you plan properly, you might be able to get a gift. You might be able to structure that. I always tell people, speak to your family members, because sometimes the CMHC premiums all like $30,000 on like a $600,000 house, let's just say, right? So imagine you're paying that. So, and the difference, say you had 40,000, you need an extra 80 grand, right? So if your family member lends you 80 grand, you could literally, if you wanted to, pay them $30,000 for the fee that CMHC is not getting. So when you break that down, like, you can't get that ROI.
Yeah.
Teen, where can you find that ROI? Like, you know what I mean?
Which is return on investment, guys.
Oh, sorry about that. Yeah, my mistake. Where can you get that? You can't get that anywhere. So, I think it's important to seek additional down payment from family members or friends or whatever, just to help you purchase your home, because you could save so much money that goes to the government, and people don't realize how much it is, right? Like, if you think about it, the difference usually on a monthly payment, so between a 30-year amortization and a 25-year amortization, over 5 years, you would pay that insurance premium. So I could give the same, payment and pay that to my family member. But again, it's not supposed to be a loan. So you got to be invested into that. So that's just you helping someone and saving them and allowing them to get into the housing a little bit faster, a little bit easier, and they can last longer. Like, a lot of people nowadays, their house has gone up so much, and share the wealth, man. Like, please, parents, please share the wealth with the kids. They need it. I do applications all the time, and they don't have the down payment, and they also struggle to have those conversations, right?
Yeah.
But money's so cheap right now, and I don't want people to just throw around and waste it. But then, you should see if you could help people get into the market while you can.
Yeah.
Because it's hard. It's very hard for some people. And if they can get to 20% down, makes a big difference.
Yeah.
Like, your options open up to different type of stuff, right?
So you touched on amortization. So this is going to lead into my next question, because I'm not sure if people know what that means exactly. But when you talk about amortization, this leads into mortgage rates and the difference between, a fixed mortgage rate versus a variable mortgage rate. Can you kind of dip into, the differences and why people choose a fixed versus a variable?
Okay, so I'll just define amortization. So amortization is the length of time it takes you to pay off your mortgage. If you buy a house with less than 20% down, the longest amortization you can have is 25 years. If you put more than 20% down, you can go up to 30 years, and in some cases up to 35 years. So, which is very important in qualifying and servicing certain debts. Now, fixed versus variable rates. So a fixed rate is a rate that doesn't change throughout the time of your term. Mortgages are usually put into terms. So you have your amortization, which is the length of time to pay the mortgage to zero. And the term is that you're in that specific rate, right? Usually you hear 5 years. And it's kind of silly because Canadians move every 3 years, especially your first two homes. So signing up for a 5-year mortgage can be detrimental to your long-term plan, because you could be subject to penalties if you have to pay off your fixed mortgage. And I guess, Craig, you'll share your story after this.
Definitely.
So your fixed mortgage, so for 5 years, your payment would be the same. So that's good in periods where you think rates will be rising. But there's also variable rates. So variable rates are linked to what they call the prime lending rate. It could either be prime plus, or in most cases, it's prime minus. And that variance changes depending on the banks, what they call their cost of funds. And then what they mean by cost of funds is how much do they pay to borrow the money that they lend to you. Because banks just make money off a spread. You know, it's like buying and selling. It's like flipping. You know, I'm buying something for one price and I'm selling it for a price higher. That's what banks do. They borrow money at one level and pay it out the other end, right? So variable rates can fluctuate with the Bank of Canada rate. Bank of Canada meets, I think they meet every other month. So that would be 6 times a year. And they set the policy for the overnight interest rates, right? And then what the banks do, they set that based on their prime lending rate. And a prime lending rate is the best rate that they give their best customers. So you could have a mortgage rate that's like prime minus 0.5%. Okay. And an example right now, prime is 2.45. So you would be paying 1.95. But if the rates go up, if Bank of Canada says rates go up by a quarter percentage point, now you'll be paying, 1.25%. And that can change based on what they set the guidelines on that specific date.
Okay, and you're saying the Bank of Canada determines, when an interest rate goes up. Is that just based on the economy of how the economy is moving in Canada? Like when they determine something's going up, what factors are in place?
A lot of factors, like everything's in place. So it's about the entire economy. So we just went through the pandemic. So that's probably the best example I can give to people. Yeah. The economy was shrinking. People were losing jobs. So one way that the government or the Bank of Canada can stimulate the economy is by lowering interest rates. If you lower interest rates, it would incentivize me to borrow more, or. So when you lower the rates, as you see, i.e. with houses last year, everyone went crazy. A lot of the reasons, pandemic, everything, people losing jobs, but people were buying prices. Why? Because rates went down by 2%. So on a $500,000 house, that's almost $1,100 a month that you're saving, right? That's what happened. So now if I told you, Dean or Craig, you have $1,100 more to spend, what are you going to do?
Take it.
And
Take
buy
it
a
and
bigger
run.
house, right?
Yeah.
Or that same house that you would have bought for less money, you're going to buy for more money now because you want it so bad, right?
Yeah.
And that's what's going on. And that's there's a direct correlation to the increase in the value of real estate to the drop in the interest rates. So when I say they set the policy based on what's going on in the economy. So if you want to pay attention to what you think rates are going to happen, you could pay attention to the economy. You could sit there and say, hey, what am I reading in the news? What's going on, right? So if we even were having a healthy discussion right now, based on what you see in the economy, what do you think the direction of rates are, Craig and Dean?
I feel directions of rates is just going to continue to drop.
Okay.
Yeah, continue to drop.
Okay, and why do you think that?
Because of the current economy right now. We're in a pandemic. Things are closed down, things are shut down, and it's taking a lot of pressure on the people like us, like people that have small businesses. We actually can't contribute to the economy because we can't go out there and stimulate the economy by purchasing various things because everything is shut down.
Yeah. But that's kind of controversial in one sense because if you think about it, like if you're a small business owner, even though Bank of Canada lowered the rates, like how much did it affect your day-to-day business? Right. Yeah, so it affected real estate agents, mortgage agents, people like myself. You know what I mean? So it's an interesting debate because it's like, oh, they stimulate the economy. Okay, so some people are working, but if you think about it, it's really hard. So this is when you hear like everyone talks about that trickle down economy. Like, does it work? Because this stuff makes rich people richer. When you if you have a $10 million loan and then they drop the rates by 2%, what do you think that does to your $10 million? Right, so it's interesting. It's an interesting thing and it's an interesting topic. But again, if you're someone there listening on the outside, if you want to pay attention to where you think rates are going to go, all you have to do is literally pay attention to the economy and kind of see what you think is happening. We know as people what's happening before it happens. Like it's nothing new. But again, we just don't know how it affects our bottom line. You know what I mean? You don't know how, there's thousands of jobs being lost. Your job may not be affected, but it affects you. But you just don't really know how much it affects you, right? So it's pretty crazy.
Yeah, and as Jason mentioned, I had a little background story with regards to, fixed versus variables. Oh, and gem time. So I'm going to take you through an experience that I went through. And again, this podcast, the whole objective of what we're doing here is we want to put people in better predicaments or situations when they're going into their first time experiences. So when you don't know something, you just don't know. So in all incitement, when I purchased my first home, I didn't really know about the economy. I was just like, I have my down payment, my savings, just get me in. And lo and behold, like Jason mentioned, people usually move within 2 to 3 years. I got a fixed 5-year rate. And then one of my friends said, hey, let's take a drive up north. I live up north and, it's not that far from where you live. And, me and my significant other said, yeah, why not?
Yeah.
And that's the worst thing you could ever do, guys. Don't go house shopping or taking a look at other properties when you don't have everything lined up. So lo and behold, we took a drive, and I end up opening my checkbook to put down $5,000 on another property, thinking that, we were here for 2 years, we can move. But that was a hefty penalty. When I went to the bank to break that 5-year agreement fixed, I got hit hard. Like, it felt like a punch to the gut.
How much was it?
It was approximately 20 grand.
Yeah,
I think.
Crazy. Yeah.
And I was like, damn, 20 grand just like that. And it's something that, we didn't want to turn back because I opened my checkbook already, put down 5 grand on something, and I didn't even put my house for sale. It was just an impulse thing. And again, guys, like, plan things out. Don't fall into that trap of doing something on impulse, because it screwed me out of $20,000 very, very easily. So,
I just want to interrupt a little bit, just because so people understand what a penalty is, right? So what a penalty is you're basically breaking your contract with the bank. So if I told you that I was going to promise to pay you X amount of dollars for the next 5 years, and I tell you now I don't want it, like, wouldn't you charge a penalty, right? You'd want that because you're expecting that income to come in. Yeah. So a lot of the times we have to remove the fact that yes, the bank's big, they're massive, they don't need the actual $20,000, but if they did that for everyone, then they would be broke, right? So it's also a business in a microscope, right? So what they do is they do one or two things. It's either 3 months interest expense or what they call an interest rate differential, right? And what that is basically they look at what they would have made on the mortgage compared to what they're going to make now because you broke the term, and they charge you that difference. And that's essentially what they're doing. Any business person would do that. So it kind of sucks. I'm for the people, but I'm for the people who plan.
And that makes fantastic sense. So in that sense then, so what if, and it's something I didn't know before that I know now, what if I would have ported my mortgage?
Yeah, that's something obviously, I'm a professional and I'm not going to talk about what somebody else did to you. I don't know why you didn't port, but sometimes porting doesn't make sense. So there are some banks, the rules around porting are strict. So I don't know your situation. I don't want to comment on it, but maybe the bank that you're with didn't allow you to port. Or sometimes they have like these weird clauses in there and the timing just doesn't work out.
Okay.
Or sometimes you need bridge financing. And what bridge financing is if you don't sell your home or your home doesn't close in time when you're getting your new home and you just need some money for a little bit, maybe just the timing doesn't work out. Like some banks allow up to 6 months and you'll get your money back. Some banks don't. So it depends on what situation you're in. And a good mortgage agent would ask you these questions before they get into like a term discussion with you. Like, how long do you think you're going to stay at this house? So I always tell people, let's not talk about rates till you find a house. Because then I ask you questions like, oh, how long do you plan on living there? You know, and if you tell me anything less than 5 years, I'm giving you a variable rate off the jump.
Mm.
You know, do you love this home? Nah, it's a starter home, variable rate. You know,
Yeah.
or oh my God, this is my dream home. I'm not leaving. Pool, everything. Kids are here. I'm good. Okay, you could do a fixed rate, but everybody else, I'll slap them into a variable rate sometimes. You know,
Okay.
and it bites me in the butt. But hey, you know, then it pays off. But then there's those people that stay for 5 years. So it's listen, man, it's so wild. Like you never know. So you have to prepare for everything. So if you do take the fixed rate, know that if you break it, there's a penalty.
Makes sense. So, another hot topic question. Why isn't location important in today's climate?
Why isn't?
So, the reason why I pose that question is that, you know, when you think about real estate investment, everyone talks about location. The current environment that we're in now, is location still a big thing?
Well, I think proximity might be the better word you're trying to say.
Okay.
Like, do you need to be close to things like go transit, downtown, work, a mall as you used to? No. Location does still matter because at the end of the day, like you're not going to buy a house where it's far from, let's just say like a highway, right? Or whatever, right? So I do think people are still buying on location, you know, where you're seeing the increased values of the houses is in the suburbs, but they're still in neighborhoods where there are things that go on, right? You know, like Durham went crazy. But Durham's highly developed, right? You know, people are moving up north to Muskoka and some of these places, but these places are becoming highly developed, right? So there's still great locations. So I still think location's important, especially when you're making an investment decision like a house. But it all depends on what you're buying, right?
So I have a question for Dean. How important is location to you?
To me, it doesn't matter. As long because I got a car, so I can drive where I need to go. So I could care less where I'm living.
Yeah.
But for me, like, when I hear people say location, I try to go where I get the most bang for my buck.
Okay.
So me living downtown Toronto wouldn't make sense for me. Why? Because everything is close to you, but the size of what you're living in doesn't fit for my family. So I got to be going further out to get the most bang for my buck in terms of square footage. So for me, location, it doesn't really matter so much as like in city, like if it's city or the suburb life. So to me, I'm not so hung up on location so much. It's just where I can get the most bang for my buck.
Yeah, I think that what you're saying is very true because for me, location not so much. However, I do want to be close in proximity to certain things. You know, I have kids, so you know, for me, I want to be able to make sure that if I need to go to a grocery store, I'm not driving 3, 4, 5 kilometers away, or if it's something that's recreational, like a Wonderland. You know, I don't live too far from Wonderland, about 15 minutes. So it's something that, you know, the malls are there, Vaughan Mills and all those other things. So again, I'm not, it doesn't really matter to me, but as Dean mentioned, I wouldn't be looking for something downtown because, you know, I have a family. Downtown is way fast paced. It's just a lifestyle that I don't want, but, you know, there may be people that are single, no kids, the millennials, you know, want to be close to the bars, the clubs, the restaurants, and that life fits them.
Yeah, what's happening?
You know, they want to be in the happening spot. So again, I think location just kind of depends on where you are in your life and
where your life stage is, right? And
exactly.
That's why it's important to plan as well, right? Because you never know. But like, listen, like I love downtown, and I moved to the suburbs because I just wanted space. I still miss it though. The food. Uber Eats sucks in the suburbs.
but now it's a catch-22. So if you were downtown, you mentioned food. You're amongst all these top-notch restaurants, close in proximity, what do you think you're going to be doing? You're going to be spending a little bit more because, you know, you want to get that.
Of course.
You want to get that fine dining
no
cuisine.
saving.
There's no saving.
Saving downtown. Come on.
So, hey, I think you're damned if you do and you're damned if you don't. You know, either way, when you do move out to the suburbs, there's certain things you're going to miss. But as Dean mentioned, you're going to have that bang for your buck. You're going to have more space. You know, maybe
No surcharges on Uber Eats.
Exactly. So all those things, they do add up.
No,
in the long run.
For sure.
So,
and yes, as a mortgage agent, you got to have prudent savings habits and stuff like that. And don't spend all your money downtown in the clubs and the bars. When they open back up, because hopefully we're going outdoors soon. Hopefully, when outside was a thing.
Well, yeah. Honestly, to me, I don't mind it because I'm saving.
Yeah.
You know what I mean?
I mind.
Yeah, you know what I
For
mean?
all those soca heads in February, I'm depressed with you.
Well, you know what? The one thing, and I see a lot of things on IG right now, you know, people are like, yo, you know, this is the time I would be in Trinidad.
Yeah.
You know, living it up.
Yeah.
But
It's funny that you mentioned that because it's allowing people to become more innovative, like with the way they're doing parties now. Like Saturday night, I'm getting 4 or 5 invites to a party where it's like you can party in your house now, and you're saving that money. So those people that want to be purchasing a home, that money you would have been spending in the clubs, $200 on a bottle. That $200 could go towards your down payment or your closing costs, you know?
Or to your RSPs. Then let's talk about that because no one ever uses that.
Yeah.
And I know you didn't ask the question, but
no, it was next. It was next. It was next on my docket.
Okay,
Don't worry.
ask the
But-
question then.
No, but go ahead, man.
Oh, damn it.
You
I should've
are.
waited. I got ahead of it.
You have that crystal ball, man. Give me the lotto numbers, man. 649.
Oh, six-
Lotto max,
I
man.
don't play lottery. Anyways, what was I gonna say? RRSP. So an RRSP is a registered retirement savings plan, and it's created so we as individuals can save on our taxes in the short term, and hopefully when we retire, we pay less taxes on the income that we do earn. So it's just a way of able to save for the future. However, the government allows you to use your RSPs twice, lifelong learning plan, or, you know, with your first time home buyer plan, right? So they call it the home buyer's plan. So if you want to go buy a home, you could take up to $35,000 from your RSPs, right? And in some cases, at a average marginal tax rate of 40%, that's upwards of $15,000, $16,000, $17,000 in tax refunds that you can possibly get on that money that you put into your RSPs, right? Wow. So if you sit down with me prior to you buy your home, because you have to leave the money in there for 90 days, I might be able to help you get a $17,000 return. Because a lot of people, when they're buying a house, they have that $35,000 saved, maybe in another account, right?
So what would you say to people that, because there's both people on both sides of the spectrum, what do you say to those people that, you know, say RSPs, nah, you know, why am I going to get into that when I can just invest or flip something?
Because people don't like money. It's free money. It's free money. Like, I don't understand it.
Yeah.
Like, it's a benefit that you can get. And who cares if you have to put back to $35,000 over 15 years? Like, okay, that's not a significant amount of money. Or they'll just add it over to your taxes over a 15-year time period. If you're a smart, prudent financial person, you would take all the free money you can get. Like, why wouldn't you take free money? Like, that's what I don't understand when people are like, I don't want to use it. Like, you're just lazy to learn. Look into it. Like, I'm not telling you to listen to me, but look into it. Most people who plan to buy a home, they use it, right? Now, there's some cases you don't have that RSP room. And where do you find that room that you have? You go to your notice of assessment, and on the back of it, it will tell you your unused RSP contribution room. Most people, if you're over the age of 25, you have $35,000 in contribution room. Because what it is you get 18% of your previous year's income added to that.
Okay.
Right? So most people by 25, you know, you've earned enough money to have $35,000 available in contribution room. Now look at it as a couple. That's an extra 30 grand potentially, right? That's more than your closing costs. That will help you buy your home, right? But this is just tips, man. This is nothing. You don't have to do it. But like, I think I just see so many people do it, and I don't know if there's any statistics on it. And maybe one day I should look into it. But like, nobody uses it. Like, I would say 5% of my clients that buy homes, maybe 10, actually have a RSP prior to them buying it. And the ones that have it don't even know they have it sometimes. And some people have it, don't know they have it, been sitting with their employer, go buy their house, and then realize they had all this money sitting somewhere.
So do you think it's just due to a lack of knowledge, or people are just negligent in knowing what they have?
I think it's a lack of knowledge and a lack of like, oh my God, I got to buy this house. I got to do this. Like people, we get overwhelmed.
Yeah.
You know, and then at the same time, I find a lot of professionals like myself, we get excited about closing the deal, that we forget about some little things like this, right? Which is important, you know, and I'm honest, I've done it too, like, you know, but a lot of times I try to tell customers and they don't want to listen in the time, or it's a lot of, oh, I don't want to do it, it's too much work. Or sometimes, for example, if you're buying a house in September, when I tell you to do it in September, but you don't get your tax refund until like next year, April, you don't see that benefit. So right now in February, when I tell people to do it, they see it because they get the money back right away. Yeah. But in most cases, it takes some time, right? So that's what it is. It's like we're in this instant gratification. RSP is not instant. It takes time.
And I think it's a mindset, as you said it. A lot of people are into things because it's instant gratification, and they don't know that, you know, when you're doing certain things, it's over a period of time is where you're going to see that, you know, you're going to see that end of the light at the tunnel type of thing. You'll see what you're doing when it's a longer period of time, as opposed to instant gratification. And you mentioned free money, like a RESP, which is a registered education savings plan. A lot of people don't know that the government gives you 20% free. So why would you not want to set your kids up for the long run? You know what I mean? A lot of people mention this, and I see people, you know, even put this on Instagram. I would rather go broke broke myself than see my kids. But why do you have to go broke? You know, why don't you just teach your kids what you didn't know now, so you're setting them up for the future? You know what I mean? So it's just a situation in which that I think it doesn't make sense. Like, you know, when you can get free money, or you can get access to free money, why would you not do it?
Yeah, it's crazy. It perplexes me all the time, and I wonder what people are doing. But hey, listen, you know, we've all been there. We've all made mistakes.
Yeah, of course.
We could correct it, and I hope people take advantage of these programs that are available, because there's a lot, and I'm sure the government will come up with more. Like, they have the first-time home buyers incentive, what they'll give up to 10% if you purchased a new home, and 5% if you purchase a resale home. And what that is, it's like an equity sharing program. And I want people to pay attention to this. Think about this, and I want to break it down a little bit. Like, when they say equity sharing program, like, why would the government want to equity share with you? So if you think about it, they must know that prices would go up, because they wouldn't equity share with people if they knew prices would be going down. They'd be losing money. So if they're doing it, like, why wouldn't we as people, you know, group economics, work with people and equity share in buying homes? The government thinks it's a good bet. They must know something we don't know. I don't know what they know, but they're willing to do it, right? Yeah. So so basically what they do is, if you buy a home, they'll contribute 10% towards you. You have to pay them back that money. And you have to pay them 10% of the increase in the valuation of your property. But that's a fair trade. Like, I'd do that any day. And on top of it, it's like you get to pay down your mortgage faster. So you save money on interest. Yeah. Because you don't have a mortgage on that 10%. If you have a home that's $500,000, that means you're not paying interest on $50,000. It's not a lot of money in the grand scheme of things, but over 25 years, it makes a big difference. You know, you save a lot of money. So there's so much things that people can take advantage of if we plan. So again, moral of the story today, plan your mortgage.
No, it is definitely important, and it kind of comes down to, you know, between myself, Dean, and Jason, you know, we'll be doing this on a weekly basis and dropping gems, but we also have a course out there that can also help you, that you can kind of, you know, do on your own time, and it's an online automated course in which that, you know, it's called the Money Management Method, and Jason has a Mortgage 101 aspect of, you know, teaching people. You know, we talk to people. You know, the course, like I said, it's automated and narrated, so you can pick it up at any time. and we're just trying to, build a community. Jason talked about group economics, and we're trying to build a community. So this information is definitely, you'll hear it if you tune in, whether you're listening or you're going to be viewing it. But we also have a course out there that will help people that you can kind of work at your own pace, help you see and help you plan, for your future. Because if you don't plan for your future, what's going to happen is that, you're going to impact others, which could be your kids. You know what I mean? It could be maybe even your parents. Maybe your parents are getting old, and you may want to take care of them. So these are the things that that are out there. It's called the money management method. We help you better your relationship with money, and just teach you the fundamentals on what you should know. Because again, you don't know what you don't know, and it's important that as a community, when we're building, there's no secrets. We don't want to. It's not us taking the information and putting it in our back pocket and say, you know what, nobody needs to know this. There's no point to it. At the end of the day, I say this to Dean all the time. Why would I want to only eat at the table with 2 people or 3 people when we can all eat at the table?
Most definitely.
You know what I mean? So, it's just very important, and it's just the mindset of individuals out there. We just have to get our minds right. Once the information is out there, and it's easier to make that decision, or it's easier to say, you know what, I'm not going to do that because I heard it on the podcast, or I went through the course, and these guys, they're honest in what they're saying. I'm not going to go that route. I'm going to plan better because I want a better future for myself and my family.
Yeah, and that's important, man. Like, a shout out to you guys for creating the book. It's inspirational, even to myself, who's someone's in the finance world. Glad to be a part of this process, and let's kill it with a lot of content and information that can help people do a lot of stuff. And yeah, my mortgage 101 included in the money management course will provide you more details on everything that I just discussed. It's impossible for me to show you. You can't even see me, so
There's a reason for that, guys. There's a reason.
To show you,
anonymous,
to show you the details. But when you take the course, you'll understand it in greater detail, and then I think people will be able to make educated decisions when they're purchasing a home, especially in this market, man. It's challenging, and you got to be prepared more than anything. But yeah, man, I hope everyone has a good week, I guess, man. That's for me.
And we'll see you guys next week.
Checks over strikes podcast. Checks in your name. No strikes against it. Signing off. See you next week. Peace.